Hey, we're now live. Okay, ladies and gentlemen, welcome to the Superlative Podcast. I'm Edward Bushi. One guest, no edits, no post production, just a short live conversation about what it takes to get to higher levels and what comes next. So let's get into it. I want to give a big introduction to Peter Harris from University Growth Fund. He's watched as an investor lose fund his whole fund for being a bad actor, and a founder implode a company on self dealing. So you've seen a lot on your side from interacting with different founders, and you built the opposite bet that being genuinely win-win is the highest return strategy in the venture. So would love to get into that. And before we get into your story, Peter, would love to know what University Growth Fund is, and yeah, we'll start from there.
Sure. So, University Growth Fund, we're the largest student run fund in the country. We manage about $100 million across three different funds. We do early growth stage venture investing and now recently launched a private credit and private equity fund that'll do more traditional leverage buyout type deals, giving students a full spectrum of experiences across private markets. So really excited about that.
Mm.
Um, at the fund, we've made quite a few investments in a lot of companies that people have heard of, everything from Anthropic to Airbnb to Lyft and Postmates, Toast. Next time you're at a restaurant, pay attention to what they use to pay for your bill.
Mm.
Um, and so what's fun is the students get to really run the fund. So they do all the due diligence on the deals. They get a vote on which deals we end up investing in. And then post-investment, they help our portfolio companies with different value add projects. And so the benefit is that they gain this real world experience that they can talk about in interviews. And that has been a massive differentiator for those students. Many of them have gone on to launch their own companies and raise money from venture investors.
Mm.
Many have gone on to work at venture funds, private equity funds, hedge funds, real estate funds, and quite a few have gone to work at other areas such as working for startups, working in financial services, and so forth. So it's a lot of fun. It's a lot of work, but I love it.
Yeah, that's amazing. Like it seems like it's almost like startup school for both sides of the ecosystem, right? For founders as well as VCs. So it seems like what you're building has is a great start for a lot of people in the ecosystem. So I'd love to just get into a little bit of your backstory. I did some research um, on you and UGC before UGF. You launched micro franchises around the world, including in Ghana. If I research correctly, what did building tiny businesses in hard places teach you that you still use when you invest or operate today?
Yeah. So that was when I was with Fairborn Consulting, and we were kind of like entrepreneurs for hire. So what we would do is, a micro franchise is kind of what it sounds like. You think about McDonald's as a franchise. It's got products and systems, brand, corporate support, a lot of those things that really drive down the risk of operating and starting and operating a new business. And so we took those same principles and would shrink them down to businesses that could be operated at the bottom of the pyramid in developing markets. So, across Africa, South America, Caribbean, et cetera. And so, as part of that, oftentimes what our clients would have us do is come in and identify different business opportunities. And, you know, my approach to that was I would spend a lot of time walking around markets, looking at prices of things, talking to people, trying to tease out where things were inefficient,
Hmm.
where people were paying too much for something, or where they didn't have access to something that I had seen perform well in other markets, so that we could identify, real areas of need and potential demand. Um, And I continue to leverage that same kind of mindset when evaluating companies, is truly trying to figure out, like, in your given market or sector, where are things broken, right? Where is the economy not really performing the most efficiently possible? And usually that's where there are opportunities to create a successful business.
And what are the tells? It sounds like it's just looking for places that have high prices for goods that or services that shouldn't be this high. Is that one way of knowing where inefficiencies are?
Yeah. So, for example, recently we looked at a deal in the logistics space. And what this company is doing is they're leveraging AI to automate a lot of functions within that business type that they're acquiring. So 80% of the expense in one of these businesses is from humans picking up the phone and making phone calls. It's not particularly intellectually engaging work. It's very inefficient because they can only make one call at a time.
Hmm.
And so they're coming in and basically saying, we're going to replace those humans with AI that can make 100 calls simultaneously, and much faster, and do it at a fraction of the cost.
Hmm.
And so things like that are like good examples where you look at that and you say, there's like the expense load here is like way too high, the margins are too low. There's probably an opportunity here to bring in a new technology that would increase productivity substantially.
Oh, optimize things.
Sometimes it's cost savings, sometimes it's more upside. So it just kind of varies.
Yeah. So before I mean, like going into university growth fund, right? You it's basically a fund that runs with 50 students across several schools. Like to me, that's a very interesting setup for like how to like even set up a fund. How did things turn out that way?
Yeah, so I wish I could take credit for the idea, but the history is back in the late 90s, early 2001, there was a group of students that were just really passionate about venture capital.
Oh,
And
okay.
they started a club, and they started doing due diligence for local funds in Utah. And several investors and entrepreneurs found out about what they were doing and came to them and said, "Hey, this is cool, but it'd be more cool is if you had your own fund and you were making investment decisions on your own account." And so those people helped those students launch the first fund, which was University Venture Fund, that did a first close on the fund in 2004. I joined that fund when I was a student at BYU in 2007. And shortly after I joined, the two principals left to go pursue other interests. And they brought in my now business partner, and he and I revamped soup to nuts, the whole fund, and then
Hmm.
continued to operate it. So we did that together for a total of about 8 years, and then spun out of that fund and launched University Growth Fund back in 2015. Um,
Wow, 9 years,
and
11 years ago.
yeah, 11 years ago. So we raised our first fund in 2015, raised our second fund in 2020, 2021, and have been actively investing throughout that whole time period.
Yeah, it speaks to the track record and success of the fund being running for that long. So before we get to the thing that I wanted to really dive into, right? We're talking about game theory, right? And how you were talking about how it's all about having both participants on either side of the game play games with that win with each other. But it's game theory, right? I'd love to know like just a small framing of it, and then how did you realize that's something that needed to be looked at when you were operating the fund? What did you realize that early, or was that something you learned along the way?
So one of our core principles at University Growth Fund is to create win-win-win outcomes. And
Nice way
it
of putting
became very apparent to me that when UGF was at its best, it's when we were doing that.
Hmm.
And so what does that look like? Well, it looks like we don't, sometimes people look at our program and they say, well, it must be nice. You have a bunch of, cheap labor with the students who, do all your work for you. And I respond, I'm like, it's actually more work to have a bunch of students because I'm constantly recruiting, I'm constantly training, I'm mentoring them. I'm like part therapist, part professor, part investment manager. It would be far easier to just run a fund without a bunch of students, particularly when you take into consideration that like students are very transient. So we're just constantly on this rat race, rat wheel. It feels like. That said, that's okay. Like that's why we're here and what we love. We love working with students. We love teaching them. We love creating a really great experience for them, and that's important to us. What we want to do is create one of the best, if not the best, experience for our students that they can learn and gain real world experience. That's important for the students, but it's also important when we go and talk to founders and investors because they look at it and they can see the tangible impact that we're having on the lives of the students. And that gets us access to really compelling investment opportunities that would be hard for us to get access to without that component. And so that ends up being a little bit of a superpower for us, is just being authentic about having real impact on the lives of our students. Therefore, getting access to really great investments. And then that in turn drives really good performance, investment performance that our investors really appreciate and therefore are willing to invest in the fund, which in turn makes the whole thing sustainable. So the idea that, that I mentioned to you prior to this discussion was, I studied economics in college and I took a game theory class. And, the classic game theory scenario is the prisoner's dilemma. And I think we're all familiar with it, right? There's two prisoners, they're put in separate rooms. If they can keep their mouths shut, they both go free. But if one rats the other one out, then, they'll go free, but the other person will be kept in prison, or maybe they'll stay for a little bit, but their sentence will be a lot lower. But if they both, rat each other out, then they both, end up staying in prison. And the Nash equilibrium, as they call it, is that as much as they would like to both get out of jail free, they're incentivized by the game to rat the other person out. And so you end up with the suboptimal outcome. Well, they've done a lot of studies on that scenario and tried to identify different ways in which you could kind of break it. And one of the ways to do that is introducing the idea of a repeat game. So you don't just play the game once, right? In Prisoner's Dilemma, it's assumed that it's a game that's played once. But if you play the game again and again and again, you can open up different outcomes, right? Because people then can see the choices that were made in the past. Maybe they can collaborate on choices in the future, et cetera, et cetera. And so it brings to mind this idea of, you want to play repeat games with people that benefit you as well. And so what does that look like? Well, instead of looking out for yourself, you look out for the other person. You ensure that they have a great outcome as well. Because when you ensure that like the person on the other side of the table has a great outcome, then they'll want to work with you again. And what ends up happening is you can build these relationships that start compounding in the same way that you have compounding interest, where trust increases, mutual knowledge and respect increases, desire to improve both parties' outcomes increases. And so over time, those relationships can become more and more and more powerful. And so that kind of ties back into this idea of this like create win-win-win outcomes. And what's been fascinating it now is one of the benefits of putting so much time and energy into creating a really great experience for our students is that our students now are incredibly loyal back to the organization. You know, many of them feel like they wouldn't have achieved the level of success in their career that they've achieved without our program. And so they feel a deep tie to give back and support our program. What does that look like practically? Well, we've had multiple students become investors in our fund. We've had students bring us deals. So some of our, deals that have been some of the best performing deals have come from students. So, the first investment we made out of our first fund was in Lyft, which came from a former student. More recently, we made an investment in OpenAI that came from one of our former students a few years ago.
Wow.
And then we've had students start companies and raise money from some of the best venture investors out there, and they've carved out parts of those rounds for us to participate. So there's these opportunities, and I think in business, so often we're like, it's eye for an eye, it's winner take all, and I think that is just a very short-term, low profit way to think about business. I think the bigger opportunities exist where you say, no, it's not a winner take all. I'm going to give up a little bit potentially in this round because I want to play with this person again and again and again. And the cumulative gain that I will get over the multiple repeat games that we'll play will more than outweigh anything I might have given up on this first round.
Or more than the gain I would have gotten if I played the game once but only did it for myself, that kind of thing.
Exactly.
Man, you remind me of a concept of maybe this is related to it, but of infinite games, right? Where you it's all about it's not about pitch battles where you have to win and that's it. The game keeps repeating. And I love how you add another element to it, where you look out for the other person. It's more like collaboration.
Yep.
I wonder, from your point of view, why a lot of I guess, businesses don't think that way, or don't think in infinite games, or don't think of win-win-win, or is it just because the incentives are so tempting that they don't? From your point of view, why aren't more companies doing this more?
So I think there's a lot of factors. I think one, it can be a little bit scary because really, I think the reality is because people aren't willing to invest the time and the vulnerability required to create creative solutions. So what I mean by that is, if you and I are going to come to an agreement on a deal, the best way for us to get to an outcome that's mutually beneficial on both sides is for us to both be fairly transparent around our objectives, our resources, our situation. The problem is that we don't trust each other, right? Not you and I, but in general, people don't trust each other to be that vulnerable because we're afraid that people will take advantage of us. And so when that happens, it really reduces the level of creativity that you can bring to a partnership or to a transaction, right? So often we anchor on things like price, right? Or monetary value, when in reality, there might be a lot of other things that we care about. So if I'm participating in a deal where we're buying a business from an owner, some people might look at it and just say, whatever the highest price is what the owner's going to care about. But it turns out in many cases, owners care about a lot more than just the ultimate price. They care about how their former employees are going to be treated through the transaction. They care about their legacy. They care about the brand. They care about a lot of those things. And so understanding those different levers can allow a fund to come in and make an offer that might be lower financially, which would benefit the fund, but pull on some of the other levers that are very meaningful and important to the seller. You see this in venture too, right? I'm a big proponent of don't take the highest valuation, take the best deal with the best funds, with the people you want to work with. Because life's short, and you shouldn't be stuck working with somebody you hate just because they gave you a higher valuation than somebody else. So those are just like simple examples, but when I think about University Growth Fund, just because it's one we've talked about, there's a lot of places there where we've made clear decisions that on the face may not sound, fully rational. So like I've spent in the last couple of months probably like an average of 20 hours a week just on recruiting, interviews, resume review, all of that kind of thing, right? It's a huge drag. People could also look at it and say, like, I am very thoughtful about this type of work I have our students do. I joke, I'm there to get the coffee for the interns, right? Other people could look at that and say, that's stupid. You have all these people, like, put them to work doing the menial tasks and save your time for the high value stuff. But for me, by me taking care of some of the low value stuff so the students can gain experience doing the high value stuff, I'm able to create a program that is far and away better than pretty much any other investing program out there. And that's what results in students getting placement, us getting access to great deals, and attracting really good investors. So it's that idea of like, how do you think creatively about the situation and bring in, different levers or different approaches that allow you to achieve, maybe a longer term outcome that's positive.
That's pretty intense. Like, how do like, to me, like, it's kind of a balance. I've had I worked for certain organizations in the past where I had to like teach an intern a few things, right? But
Yeah.
I can relate to the struggle where sometimes you gotta like teach them how to think about a problem, or even do an entire workflow.
Yeah.
Or maybe inside the workflow they don't know how to use this app. Oh my gosh, start doing that. Like like, to me, like, how do you know? Because I feel like I'm gonna get into this again when I meet like other younger interns. When do you know this is where this is the right amount of effort to put on this individual? Because I know that it's gonna they're gonna do the job eventually. Like, how do you look for that? Because you said you spend also a lot of time like looking and scanning the people that you induct.
Yeah. Well, I mean, honestly, I wish I could take every student that was interested in our program, but we have about an 8% acceptance rate, which means, for every one person that gets in, there's 12 that don't, right? So,
Wow.
And that's mostly because if I take too many people, I'm going to end up with a subpar experience for students, right? And so, what does that mean? What do we look for? Well, I look for people ultimately that are going to take advantage of the opportunity and are at a position where they can. And what I mean by that is, what I tell students is we look for three things. We look for students that are really passionate about something related to what we do, something that's going to drive you when you're doing the work, and it's no longer fun and exciting, but has to get done. So, that could be that you are really passionate about investing, could be that you're passionate about technology, it could be that you're very entrepreneurial and want to start a company someday. It could be a lot of different things, but demonstrate to me like how you're passionate. The next piece is demonstrate to me that you're smart. There are a lot of ways to be smart, but demonstrate that you have like strong critical thinking ability, because we look at so many different kinds of businesses. A lot of them are very complex, and you have to get up the learning curve on every single one in a very relatively short time period. And then the last piece is we look for people that are great team players. They don't leave their team hanging. They work hard. They respect other people. They're nice and fun to be around. What we don't look for are people that come with a ton of experience already. If you've got it, great, because it can demonstrate passion for what we do, but it's not a requirement. My belief is that anybody who comes to our program is like sufficiently humble and passionate and driven can learn this stuff, and we have the structure to be able to support them and help them get there. So yeah, I mean, I think part of it is it's a little bit of that saying, like, you can lead the horse to water, but you can't force the horse to drink. And so what we're looking for is, those horses that are just eager to drink, right, from the experience that we have to offer.
Yeah, one thing you also mentioned to me from the onboarding call was, oh, sorry, did you hear an echo on your side?
Nope.
Oh, okay. Sorry, but this win-win-win situation is also true in the relationship, not only between you and your students, but between founders and investors as well, right? And it could be between VCs and their investors and the fund itself. Would you like to expand it on that dimension too?
Yeah, sure. I mean, so one of my mentors is this investor, George Zachary, with CRV. And when he was early in his career, he worked at the startup, and the startup failed, essentially. But it did get acquired. It just got acquired for a lot less money than they had raised. And so when that all wrapped up, they hadn't carved out any money for the common shareholders, for the employees. And so essentially what happened is almost all the employees lost their jobs, including George Zachary, and they didn't get any sort of payout or severance or anything. And he was literally homeless in San Francisco for a while, trying to figure that out. Yeah. Right? The VCs ended up taking, because they had contractual rights, they ended up taking all of the cash that was paid out, which was millions of dollars. And so, on the one hand, it was like, this was the VCs playing a one-time game, right? They were like, hey, I'm just going to take as much as I can because I'm entitled to it, out of the business. And, I don't care about the employees and the founders, and, they should have worked harder. They should have been more lucky, or whatever it might be, right? Yeah. Not my problem. Yeah. You contrast that now today with that doesn't really happen anymore, because most investors have realized that it's important. Your reputation in the next deal is more important than maximizing on the current deal, particularly if it's a deal that kind of went sideways. So, in that case, you have what's called management carve-outs, where if a company ends up getting acquired and most of the money is already contractually obligated to go to the investors, the investors and the employees will work together to carve out a piece of that transaction, so that some of the money can go to the common shareholders. And by doing that, the VCs are able to build a good reputation, so that when that founder starts their next business, or maybe some of their top employees go to start another business, they want to work with that same investor. And maybe there's other people that they talk to, so they give good references and so forth. So, I think it can matter a lot in terms of kind of creating those win-win outcomes on the investor side.
Okay, gotcha. And just to clarify, common share is basically people who, not only, we're not talking about investors, but like common shareholders are essentially the employees when they get in, and it's part of their their package when getting into the company that early, right?
Yeah.
That,
So in a business, in a venture-backed business, VCs will usually invest and receive what are called preferred shares, and those preferred shares
preferred,
come with
yes.
different rights and abilities. So one of those rights is what's called a liquidation preference, and in that right, you as the venture investor are guaranteed to be paid out of any proceeds from a sale before the common shareholders are, until you've been paid back all of your money. And in some cases, it could be like 1.5, 2 times, 3 times your money, right? You can have varying levels of liquidation preference, but the most typical is kind of 1 times your money. So, and then the common shareholders, which are the employees and the founders, own the rest of the company. And so what could happen is, let's say a fund invests at a $10 million valuation, but then the company ends up selling for $5 million. And let's say they invested $1 million. In that case, they would get their $1 million back, and there would just be 4 million left to go amongst the common shareholders, instead of them only getting 500K back and 4.5 million going back to the other common shareholders. But you can imagine how it could be even worse. Let's say the company had raised $10 million and ends up selling for $10 million, right? Then all $10 million would be contractually, obligated to go to the venture investors. And so in that case, the venture investors would have to come to the table and say, we are willing to give up a portion of that 10 million so that the common shareholders get something, right? Maybe they carve out $1 million. And so they end up taking 9 and the founders get, $1 million, which, hopefully is enough to get them, to their next job or their next startup.
Yeah, it's crazy, sir, how like higher valuations or higher sales can lead to that kind of strange outcome, and where VCs have to work with the common shareholders. So it sounds like to get into win-win-win situations, you gotta be willing to see things in more than just one game, one interaction, be vulnerable, and basically collaborative, or be gracious, like in a rough way of saying. So I appreciate all that dimensionality you gave to the answer. And yeah, I want to go back to University Growth Fund. You mentioned it earlier, and would love to like get into it more. Like, are you what kinds of like areas are you excited about now? And like, what are you building in the fund right now?
Yeah. So things that I'm really excited about is, I think there is like a tremendous opportunity to leverage AI to automate a lot of the things in our lives that don't really bring us joy.
The tedious
right?
work.
The tedious stuff.
Yeah.
Which I think in turn has this like amazing, potential to like open up people's ability to go and like actually create things. Like, one of my favorite things right now is I have multiple AI agents, and I'm just constantly chatting with them all day long. Like, oh, here's a problem I have. Build a solution for me. Like, let's automate this, right? It's like so fun. And I think most people like it when given the opportunity. Like, the ability to create is one of the things that drives us as a species. And so, the more that we can cut out of like the doldrum and the tedium that occupies so much of our lives, so we can spend more of that time actually creating, I think is incredibly powerful. So, both on the private credit and private equity side, as well as the venture side, like, I think there are interesting opportunities to bring AI to industries that traditionally have been, a lot of tedious labor. I also think like AI is going, we'll see if we actually are in a bubble or not. But I think regardless, I think the long-term potential of AI is on, probably an order of magnitude, frankly, bigger than the internet was. And so even though there was an internet, bust, it turned out that like pretty much every single company that got funded in the internet boom that went out of business today is represented by a company that's generating hundreds of billions of dollars, or hundreds of millions, if not billions of dollars. And so, I think the long-term potential is really compelling for AI in a similar way. And what that means is there's going to be a tremendous amount of demand for all the inputs to that. So energy in particular, we invested in a company called Zanskar recently. They do geothermal power. That's a deal that I probably would never have done, 4 years ago. And if you'd asked me if we were going to get into the energy space, I'd be like, I would have laughed at you. But today, energy turns out to be a very high demand sector and an area we think is really interesting. So whether it's things like rare earth materials or minerals, energy, data centers, chips, I think a lot of that stuff, there's going to be a lot of demand for it over time. The thing that I really struggle with is like traditional SaaS, which is what's really dominated most of my career. It's evaluating enterprise SaaS businesses. And that has become really tricky because I struggle to see a world in which in 5 years, I can't, just kind of prompt my way into finding the solution for whatever it is I'm working on. And so even if a business has really good success today, I have to believe as a venture and could build, frankly, like an interesting lifestyle business. So I don't want to say these are all terrible businesses that are going to go out of business. That's not the case. But as a venture investor, I have to believe that a company is going to grow and get really big in a relatively short time period, and that will continue to grow after that time period. So I have to be able to say, in 5 years, this company is going to continue to be growing and very successful, and we'll have another 5 years beyond it. And given the fact that AI is moving so fast, it's hard to envision very many of these companies where I can say, in 10 years, this is going to be a wildly successful company. And that part has been really, really challenging.
Do you mind if I can unpack that with you? Because I hear the word SaaS apocalypse, right? I know intuitively, because I use Claude on my side, I know intuitively, like, I could use Claude to hook up to different services. So I don't need to go to that service's website anymore. I just need I need my Claude to touch it. That's it.
Yeah.
Right. So like, where do you like? I would love to see what like your take on this. How does it work? Because like, what are you seeing, and what where I'm not seeing, because I see pieces on my side.
So I'll give you an example. I have a buddy. I had lunch with him. He and a friend are building a company. They make a small part that goes into motorcycles. And he was like, he's been a successful entrepreneur in the past, run a few consumer products companies, a few other businesses. And he's like, we decided day one we were going to be AI first. He's like, what that means is we built our own custom ERP to track all of our stuff. We built our own, equivalent of Shopify. We built, we built all of these different things that are custom built for our business and what we do. And so, I look at that and I'm like, okay, so he didn't buy from Shopify. He doesn't have QuickBooks. He's not going to ever buy an ERP system because he'll probably just continue to build off of what he's built. And, he's just a small little business. You multiply that across all these different businesses, and all of a sudden you start to see where like investors are saying, hey, I don't know what the world is going to look like in 5 years. And so because I don't know what the world is going to look like, I don't know how many people are still going to be buying some of these software products like Shopify and QuickBooks. Maybe they will, but maybe they won't. And because there's a lot less certainty today of whether or not they will, that means that valuations have come down. So that
Oh,
doesn't mean that ultimately like SaaS is bad or that those businesses will fail, but we're no longer for a long time we would basically say, okay, we will pay 10 times or 20 times revenue for these businesses. What that means is even if 100% of your revenue hit the bottom line, which it doesn't, right? It's usually like maybe if you've got a good high margin business, like 20% does.
mm,
It's going to take you 10 to 20 years to make your money back. Right. And so all investors are saying is like, look, it's not 10 to 20 years. It's like we're gonna value we need our investment back in like 5 to 10 years. So I think SaaS will be around to stay. I think there's a lot of benefits to it, but I
yeah.
think the flip side is there will be a lot more competition. There'll be a lot more pricing power. There'll be a lot more margin compression, and there will be likely be more churn, and all of those factors come together
Mm,
to result in valuations that are lower,
yeah.
and that probably shift SaaS as we know it from being something that's venture backable to being something that is a little bit more of a lifestyle business. The flip side now, though, is that anybody who has deep insight into a problem can now build the solution themselves to solve that problem and go sell that to customers. And so the opportunities, it's like each individual opportunity is not as big as it
Yeah.
used to be,
Yeah.
but now there's a proliferation of potential opportunities for people to tackle.
Okay, so you're painting a picture where these general SaaS-like products will have lower valuations because they can't command the pricing that they have because people can opt to build it themselves if they just spent the time on their clouds. That's what it sounds like, and because of that lower margins for the SaaS companies. But then you're almost saying the opportunity is in a targeted, unique, deploy scalable kind of solution that takes a specific problem. It's interesting. I'm thinking about it in the abstract, but like I'm trying to like seek an example of it. But it's pretty intriguing what you've shared so
So,
far.
so think about it this way, like a SaaS business faces, even if they're a vertical SaaS business, faces,
Okay.
this pulling constraint from two sides. On the one side, they want to build a product that is as tailored as possible to their customers' needs. But it can't be too tailored because if it's too tailored, then their market size is too small.
Yeah.
So where they end up is that, the typical SaaS business, and this is, I'm just kind of pulling out a number, but is probably solving 60 to 75% of a business's needs, right? Well,
Yep.
the beautiful thing about AI is it doesn't have to be that way. You could build a piece of software that now gets to 100%, or at least even like 95% of what a business really wants. Because it used to be that, if you wanted to build enterprise grade software, you had to raise a lot of money. You had to hire a lot of employees. You had to build out like, a whole sales team,
Yeah.
dev team. It was very expensive. And so you needed to have a decent sized market so that you could raise the money, so you could build the product. Today, there are companies that are just a handful of people
Mm.
that are starting a business and tackling a pretty small niche and can build a really interesting business. It may not be a venture backable business in that it's worth, billions of dollars, but it could be a business that's worth 10, 20, 50, $100 million,
Yeah.
which is very meaningful when you only have a handful of employees. So, I think that is kind of what we're going to see more of, is just more and more of these smaller businesses that are serving more niche needs than ever before. Because there is
Got it.
still value in like, I could just build it myself for my business like my buddy did, but maybe you want somebody else to handle, keeping up on bugs and the code and developing new features and customer support and integrating with new things and all that other stuff. And so like and cyber and security and so forth. So there are still like some really important advantages to having, buying software from somebody else who's kind of managing it for you. But I think the big opportunity is that now like anybody can put together something, and over time it can get better and better. And so we'll just see a proliferation of interesting businesses.
Yeah, on one hand, the tension, there's a tension here because SaaS companies won't command the high valuations and they won't be like unicorns anymore. But like the flip side is more people can get into this game and still find it fulfilling.
Definitely.
So
at least that's what I believe.
Yeah, no, but it's a really good take, and it's very new ground. And I see a lot of people like building agents or building sites that customers' agents can just like work on and edit, and it's all managed there. That you don't need to like use the interface, just use your Claude. But yeah, this is really interesting. So at that, I want to like say, I'd love to have you over and another podcast, just to cover like a lot of things in the future, if how people deal with SaaS and products like that, and even go over some wins in the future. But like for now, I want to say big thank you to like sharing your insights and telling us about University Growth Fund. Just so there we have this in the notes for people to reach out to you. You have a podcast, and do you want to like tell people how people can reach out to you?
Sure. Well, first, thank you for having me on your show today. It's been a lot of fun. It's great conversation. Good questions. So there's a few different ways that you can find and follow me. So I'm active on LinkedIn. I have a podcast called the Venture Capital Podcast. You can find episodes at vc.fm. And we bring in really interesting speakers, but then we also spend a lot of time breaking down what is venture capital, how does it work, how to work in the industry, how to raise money from VCs, et cetera, et cetera. And then I also have a YouTube channel, which is VC Pete. So youtube.com/VC Pete. And that channel, I talk a lot about, again, like what venture capital is, how it works, how it's structured, different trends that are happening in the markets. And the thing that I'm like super passionate right now about is, like I said, I think there's going to be a proliferation of businesses. And I think ultimately AI is going to put pressure on wages. Historically, if you look at the data, wages have not kept up with general growth. Every time we get new technology, everybody thinks like, oh, this will be great because it'll increase productivity, and it does. But it turns out that the gains from that productivity increase don't go to labor. They go to the owners of assets. And so one of the things that I'm really passionate about right now is evangelizing this idea that people need to shift their mindset from investing in labor to investing in assets. And so that's another thing that I talk a lot about on my YouTube channel is, how to think through that, because I think in the new world, right, the opportunity is to be an owner of some of these businesses and to derive your income off of the profits and the appreciation gains of those assets. And I think if we don't do that as a society, we don't democratize access to more of these assets, that we're going to end up with a very unequal society that will cause significant societal problems. So anyways, that was a little bit of long spiel, but if you're interested in that sort of stuff, come follow me and find me, and we'd love to chat.
Yeah, totally. After this, I'm gonna be like finding some of those episodes, and maybe that's how the next episode we could like between us would love to like circle back on that concept of democratizing ownership in 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 companies and productive items and assets there as you speak. But for this episode, I really want to say I appreciate your thoughts on win-win-win, how it applies to not only what you're doing but with founders and startups too, and founders and VCs too. So yeah, at that, ladies and gentlemen, this has been Peter Harris from University Growth Fund, and thank you for watching.